You guys seem to really enjoy videos about Warren Buffett, so today's video is going to be how Warren Buffett won big on Apple stock. I'm going to explain exactly why Warren Buffett started buying Apple stock in 2017 and how you could have easily made the exact same investment following the investment strategy that I teach on this channel. I put a ton of effort into this video, so if you do enjoy it, I would very much appreciate it if you could hit that subscribe button or at least leave a comment down below. Warren Buffett's investment strategy can be simplified into three core questions. Do I understand the business? Is it a great business? And how much cash will it put in my pocket? So let's take ourselves back to mid-2015 to see how Warren Buffett answered these questions prior to his investment in Apple. For many years, Warren Buffett avoided an investment in any tech-related businesses because he couldn't answer yes to this first question. At the turn of the century, Wall Street was churning out new tech IPOs by the hour, the majority of which had zero underlying profitability or even the potential to become profitable in the foreseeable future, and all of which operated in fast-changing industries that had yet to be established. Buffett explains his reasoning for staying out of tech-related businesses in his 1999 Berkshire Hathaway letter to the shareholders. If we have a strength, it is in recognizing when we are operating well within our circle of competence and when we are approaching the perimeter. Predicting the long-term economics of companies that operate in fast-changing industries is simply far beyond our perimeter. However, 15 years on, and of the small number of tech companies that did survive the dot-com bubble, a few of them had become simple and stable businesses that produce consistent cash flow for shareholders. Apple was one of these companies. Back in 2015, Apple was a relatively simple hardware tech company. They had just three major product lines, that being the iPhone, Mac, and iPad, with iPhone responsible for about 66% of Apple's total revenue. The business also sells consumer products, which is one of Buffett's areas of expertise. Many of Buffett's previously successful investments have been in simple businesses that sold products people love, such as Coca-Cola and See's Candy. Check out this clip of Buffett on CNBC where he explains the difference between his investment in IBM and his investment in Apple.
Apple's a different kind of business than IBM. They're both tech, obviously, in a major way, and they even have a joint venture, on some things. But I think I understand consumer behavior perhaps better than I do the tech business. Wouldn't take much.
Once Buffett had established that Apple was a business that he could understand, he then moved on and attempted to answer the second question. Is Apple a great business? A great business is defined by Warren Buffett as one that meets these requirements. It has a wide economic moat and a great management team. An economic moat is a unique advantage that a company has over its competitors in the same industry, and Apple is a company that has more than one of these unique characteristics. Firstly, Apple had built a cult-like following through their branding and marketing. Their products fit into the high-end luxury segment of the market, with their phones consistently priced well above their competition. Design has always been one of the major focus points for Apple, and for many years their products were miles ahead of the competition. And this allowed Apple to create the illusion of exclusivity despite their products' wide availability. And secondly, and arguably Apple's stronger advantage, is the software ecosystem that users are locked into once they start purchasing Apple products. The software within Apple products allows for seamless integration between devices. Photos taken on any device will be instantly uploaded to the cloud and accessible on all devices, and you can use iMessage for direct messaging and respond instantly on any Apple device you own. And this forms a standard that consumers get used to. It's what we like to call a walled garden, where it's all sunshine and rainbows while you're in the ecosystem, but they've put up these very tall walls around the ecosystem to prevent you from ever wanting to leave. If you have fully adopted using Apple products and have all of your data stored in the iCloud, ripping that data out of the iCloud will be an absolute nightmare, to the point where it's less irritating just to buy the next Apple product rather than buying a competing product even if it's far superior. Warren Buffett recognizes these advantages and spoke about them many times during many different interviews.
I see how strong that ecosystem is to an extraordinary degree. I mean, you were very locked in, at least psychologically and mentally, to the product you're using. I mean, you got all kinds of stuff up on there. It is It's a very sticky product.
It is indeed a very sticky product, and once Warren Buffett has formed a strong opinion about the advantages that a company may have, he then looks to see if it is supported in the numbers. So let's wind the clock back to 2015 and see if it is supported in those numbers. The company's growth was slowing down, but was still consistently posting double-digit increases across the board. Sales grew at less than 10% for the first time in decades, and the hiccup caused investors to panic. But Buffett has always looked beyond these short-term numbers, and Apple has a long track record of consistently growing sales, earnings per share, equity, and free cash flow at 10, 20, 30, and even 40%. The second requirement of a great business is a strong management team. One key way that Buffett assesses management is to look at the return that they are generating on their investments. Apple has consistently generated between 20 and 30% returns on their investments, which demonstrates that management is making smart decisions on behalf of shareholders. Management at Apple also had relatively low levels of debt back in 2015. Apple had long-term debt of $29 billion, with $25 billion in cash and short-term investments, as well as generating over $50 billion in free cash. This showed Buffett that management was competent at keeping debt to a controllable level. So Buffett had now established that Apple was a great business, one worthy of investment. But investing in great businesses isn't enough. We need to make sure that we're paying the right price. And working out how much to pay means that we need to calculate how much cash we expect to get back from this business while we own it. So let's do a simple discounted cash flow to see how Warren Buffett valued Apple stock a few years ago. Just before we get into Apple's valuation, if you are interested in learning more about the investment strategy that I'm teaching in this video, then I actually put together a free 20-minute training video on my website, which goes through the simple 4-step process that I use and that is taught by Warren Buffett to consistently find low-risk, high-return investments in the stock market. In the free 20-minute training video, which you can get access to via the first link in the description below, I go through each of the 4 steps that you need to go through in order to consistently find businesses that will outperform the market, and I also talk about some of the major mistakes that beginners make when starting to invest. So if that is something that you're interested in, go ahead and check it out via the first link in the description below. So here we are in the discounted cash flow calculator part of my spreadsheet, which is where we can start to calculate how much a company is worth and also how much we're willing to pay for it. The first thing we need to calculate year 0 free cash flow. And this is the cash flow that the company produced in the previous 12 months. Now, since in this example, we're talking about 2015, I've actually taken Apple's free cash flow of 2014, which was about $50 billion, and I've divided it by the number of shares outstanding to get a free cash flow per share for Apple in 2015 of about $8.20. I have then picked a range of growth rates to grow that free cash flow over the next 10 years. And this ranges from 3% to 6% to 9% to 12%, all the way up to 15%, so that we can get a range at which intrinsic value likely sits. We then need to find the risk-free rate that is available at the current time. And at the time, it was about 3%. Now, this risk-free rate can be found by going and looking at the US Treasury bonds and seeing what the current yield on that is. And the reason why we need to discount these cash flows at the risk-free rate is because we're talking about opportunity cost. If we don't invest in Apple, we can likely get 3% risk-free by just investing in US or Australian Treasury bonds. And just below that, you will notice we have a required rate of return, which is our personal required rate of return. And that will influence the buy price that you can see in the table to the right. So using a discount rate of 3% and those growth rates, as well as the starting cash flow of $8.20 in free cash flow in 2015, we come up with an intrinsic value in 2015 for Apple stock of somewhere between $161 per share, $202 per share, $250 per share, $317 per share, and then all the way up to $397 per share. And then using our required rate of return as a discount rate of 22%, we get a buy price of something like $49 per share, $57 per share, $68 per share, $81 per share, all the way up to $97 per share. If you want access to this spreadsheet, it's completely free. You just have to click the link in the description below and download it, and it is completely free, and you can mess around with the valuations for some of the companies that you're personally looking to invest in. And that would mean that according to our very conservative models, using a 22% required rate of return, we would have been willing to pay somewhere between $50 and $100 per share for this company back in 2015. In 2016, Apple stock fell into this range for about 6 months, but even Warren Buffett didn't start buying the stock until 6 months later, when the stock was at about $140 per share. But even at $140 per share, the stock offered a long-term return of somewhere between 8 and 15%. Since 2016, the stock price is up over 100%, representing a compounded return of over 30%. And while it would be impossible to suggest that you could have picked up stock at the lowest price of $90 per share, picking up stock at even $120 per share would have meant that you would have made a 15% compounded return each year over the past 3 years. I put a ton of effort into making this video, so if you did enjoy it, I would very much appreciate it if you could hit that like button and hit that subscribe button if you're new around here, and drop a comment and let me know your thoughts on this case study about Warren Buffett. But for now, guys, I will see you in the next video.